Aloha. If you are looking for thought-provoking conversations and different perspectives than you'll find anywhere in the mainstream media on the topics and issues of the day, you're in the right place. I'm Tulsi Gabbard, former presidential candidate, United States Congresswoman, surfer, soldier in the Army Reserves, and veteran of 3 deployments. On my show, we go beyond the headlines and the sound bites. We cut through the noise to provide you with unique, nuanced perspectives on all sorts of issues, along with my unfiltered views. No partisan talking points here, no hidden agendas. This is the Tulsi Gabbard Show.
Black Friday deals. The gifts are unreal.
Shop JCPenney for thousands of deals so low, no coupons needed. This weekend, save up to 50% on kitchen electrics from brands like Keurig and Cuisinart. Say yes, please, to diamonds and gemstones, now $19.99 each. And bundle up the fam in coats, starting at $14.99. We got your holiday.
Black Friday deals. Shop, JCPenney.
Offers valid on select items 11/18 through 11/20. Excluded from coupons. Exclusions apply. See store or jcp.com for details.
You are listening to an entertainment program put together by a company called Financial Ineptitude. Anything said on this show is not an endorsement or professional advice. Would you really want to tell a court of law you were suing us because you thought taking financial advice from 2 idiots on a podcast put out by Financial Ineptitude was a good idea? Really? Clown hat smiley face. Alright, well hello everyone and welcome to the China Shop. We are kicking open the doors for another exciting guest episode as the smooth and spiffy Salem Abraham from the Abraham Trading Company joins me. But before we dive into today's discussions, I'd just like to take a moment to thank our friends at Trade Pro Academy and Order Flow Labs. If you're looking for institutional quality education, be sure to check out tradeproacademy.com. And if you're into trading futures, you'll definitely want to check out the custom tools and studies at orderflowlabs.com. I'll have those links in the episode description. And be sure to reach out to us with your suggestions, corrections, questions for future guests. You can do that via email at twobulls@financialineptitude.com. That's the number 2. Or you can join our free Discord server where a bunch of amazing people gather every day to share our struggles and lessons learned with other like-minded market aficionados. Be sure to have those links in the episode description as well. Now that we got all the businessy business stuff out of the way, let's get to know today's guest. Salem, how are you doing today?
I'm doing well, Kyle. Thanks for having me on the podcast.
Oh, no, it's my pleasure. Anytime I see someone who's been a hedge fund manager for 30 plus years, that's somebody I definitely want to talk to.
Sure.
So why don't you tell us a little bit about yourself? I mean, I kind of touched on some of your experience, but maybe you walk us through like your journey, like how'd you get into the markets?
Sure. Well, I grew up and I still live most of the time in this small town in Texas called Canadian, Texas. It's a town of 2,500 people. Grew up really. I could do one thing, and that's math. I was a slow reader and a poor speller, but I could really do math, and I loved math, and I still love math. And you like the things you can do well. And so I went off to Notre Dame. I hustled through Notre Dame in 3.5 years and got a finance degree there from Notre Dame. And I came back to Canadian, ended up marrying my high school sweetheart. We got married. We've been married 34 years and have 8 kids. And so there's not a lot to do out here in the country, Kyle. So we had to make our own entertainment. But we were blessed with 8 kids and all's well there. But what I did at Notre Dame was I was trying to figure out a way, how do I make a living remotely? So it's interesting, after COVID, how easy it is to do that remotely. But, if you're living out in the country and you like living out in the country, you try to think, how do I do something from there? And as I was looking at different things, and I was introduced to Jerry Parker. Jerry Parker is a terrific legend in the futures trading business, one of the turtles. For those people who know what the turtles are, worked for Richard Dennis and Bill Eckhart. But I met him. I was still in college, and he started describing to me a math model, the idea that a math model could be used to trade futures and to make money in the futures markets. And that to me I said, if it's a math puzzle and it pays money, I'm in.
Right.
And so that was kind of the start of my journey. And so I started doing research at Notre Dame and during summers, and then in my last semester at Notre Dame started trading in the fall of '87, which was an interesting time to trade given the crash on October 19th, 1987. So that's how it started, and I started this, basically using math and to figure out what and historical data to have it be predictive, going forward.
Mm-hmm.
And that's what I did and traded for 31 and a half years. Over that period, we managed at our peak about 630 million.
Oh,
We and it was monthly liquidity, so people could come in and go out. And we averaged a net rate of return to clients of 13.1% net over the 31 and a half years. So that was front end loaded, though. The first 21 years were about 20%. The last 10 were flat. So,
right.
like a lot of managed futures traders, we certainly struggled the last 10 years we traded, and we stopped doing that in 2019. We had $206 million still under management, but we didn't think we were doing a great job, and the markets really didn't have the opportunities that we were wanting. So I would say we're not one of the very top futures traders, but we were.
I think if you're doing it
Yeah,
if you're doing it successfully for 20 plus years,
yeah,
I think you can call yourself one of the top.
yeah. My team and I had a great time, and then but we've transitioned here in 18. We started a mutual fund that came about. It's interesting how the mutual fund came about, because I was on investment committees for really from the mid 90s.
Mm-hmm.
And community foundation there in Amarillo, Texas, the Amarillo Area Foundation, and then on the investment committee at St. Jude Children's Research Hospital in Memphis. And so, which had $7 billion, and has a lot of smart people there advising them. And so, in seeing that and seeing enough financial advisors and what they do, what I thought was missing in the mutual fund space is a real understanding of how hedge funds can help you
Mm-hmm.
and have a better, more diversified portfolio. And so that was that. I started a foundation with Boone Pickens. So T. Boone Pickens and he passed away in 2019, and we were good friends. I was a pallbearer at his funeral. We had a lot of. He was very kind to me and
Mm-hmm.
was a mentor to me. And his ranch was 30 miles away from our town here that I live in now. It's Canadian Texas. He's up the river on the Canadian River. So he and I, in 2008, my brothers and I had sold him a 12,000 acre ranch. We were his neighbor, and we sold him that ranch. And he and I got to visiting about some of the charitable things he was doing, and I was encouraging him to give more money to these two counties, these two small counties. Total population amongst the two counties is about 5,000 people. So
Mm-hmm.
he and I put up $2 million. He put up $2 million. We started the Pickens Abraham Foundation, and I was able to be king of my own investment committee, Kyle. And so that's where I said, okay, I'm going to do the endowment model the way it ought to be done, which is stocks, bonds, and the right alternatives. And so for 10 years I did that, and that went really well and was a proof of concept to me. And then in 18, my team and I just said, hey, we ought to open this up as a mutual fund.
Mm-hmm.
And so that's what we did. And that's the Abraham Fortress Fund now, which is our main focus now. And it's good too, because I'm 56 and wanted to slow down a little bit, from working 60-hour weeks, maybe
Right.
to 30-hour weeks is a slowdown. And so I love the markets, love math, and that's been the journey. And then also during that time, we also did at the Chicago Mercantile Exchange, we were the very first firm to enter orders electronically. So what they call now high
Oh,
frequency
really?
trading now. We had memberships on those exchange. We got memberships on the Chicago Mercantile Exchange, Chicago Board of Trade, and so doing index arbitrage and market making on the ETFs, the index ETFs like the spiders, then the
Mm-hmm.
S&P futures, and then we also traded the Nasdaq 100 stocks back then, and that was from 98 to 2000 through 2005, and
Mm-hmm.
so that's fascinating and a lot of fun, but a lot of work too. And so I've kind of had a very interesting. I've had a fun time doing interesting things, and along the way been able to have math. Yeah. math make me money.
Oh, I love that. Okay, well, there's a lot to unpack in that. So let's go back to the first thing that I want to ask you about. The town. So that I saw that on your LinkedIn profile. Your town is called Canadian.
Yes, yes, on the Canadian
Canadian.
River. Yeah, Canadian,
Oh,
like
okay.
yeah, Canadian, like someone from Canada,
Yeah.
and yeah, and it's the Canadian River that runs from eastern New Mexico across the northern part of Texas, the Texas Panhandle, that top square, and then over into Oklahoma. So
Does it go to Canada at all?
no, you know why? Yeah, no. Well, and it's not clear why it's called the Canadian River. The best explanation I've seen, which I think is right, is that on the eastern side of the Canadian River, they had some French Canadians that had a trading post in the mid 1800s and or early 1800s because it was called the Canadian River from way back. So at some point, these Canadian traders had their trading post on that river, and
Okay.
so
So
that's what I think. That's where it comes from, I think.
so what do you call somebody from Canadian then?
Oh, they're a Canadian.
Okay, okay.
Canadianite. I don't know, Kyle.
Canadian in?
Yeah, maybe. I don't know. I don't
Okay.
know. You
All
you
right.
you call them by their name because you know them. If you
Yep, right. Okay.
you say,
Fair
"Hey,
enough.
Kyle," because everybody knows everybody.
All right. Next question I got. You said you majored in finance from Notre Dame.
Right.
Now, one of the things that I think people struggle with is finding like education when it comes to markets. Like, how much did that education help you on the path that you ended up taking, or was that like not the same thing? Like, did the courses that you took like teach you how to like actually trade futures, look at structure, that kind of stuff, or was
No,
it?
not really. I had some. I think the basic fundamentals I learned at Notre Dame. What I did that made money, they told me one professor at Notre Dame told me would not work.
Mhm.
So, and I started to kind of debate with him, and then I thought, why do I care what he
Why
thinks?
don't you just show them?
Yeah,
Yeah.
why am I going to have him educate all these smart kids coming through after me? And so, yeah, no, I was a junior at Notre Dame and in a financial markets class, and he kind of dismissed technical analysis, and
Hmm.
I discussed with him, and he anyhow. So I would say that a formal education is helpful in a lot of ways for trading. It's not a make or break deal. You can learn a lot of it on your own, the fundamentals, and then the things that I did, they didn't teach me at Notre Dame, the math.
Hmm.
It was just me. If anything, it was more a statistics class made more sense, or
Right.
there was a finite mathematics class I took at Notre Dame, which is just that's a fun subject in that it's basically the odds of numbers, where you're looking at like we've got the big lottery or whatever. You say, okay, what are the odds? How do you figure the odds of winning something like
Hmm.
that? And so, understanding probabilities is helpful, and that's finite mathematics. That was a good class. Statistics is a good class. So in some ways, the math would have been better than the finance classes.
It's
So
interesting because I think we're starting to kind of learn that as we learn more about futures. Speaking to me in the group in the Discord,
right,
that it seems like the having a real understanding of the probabilities and expected outcomes is really where the edge lies. Like being
yes,
able to collect data effectively and be able to analyze it and extrapolate, thesis out of that.
no, Kyle, I agree. Yeah, and the other piece that I think people the longer you trade, the more you understand the importance of risk management, and
Hmm.
so you tend to start off trading too large, and really the need for diversification and the real power of diversification. Harry Markowitz won a Nobel Prize in 1990 on modern portfolio theory. He had done the math many years earlier, but just the concept of it is pretty fascinating. And if you're a real math geek, you ought to look into it more and just say, okay,
I like math.
yeah.
What was the name
So
again?
Harry Markowitz and modern portfolio theory, and you look at what he did, but then you start, you just the best way to do math is get out a spreadsheet and start playing and throwing around numbers and seeing what happens, and you can have scenarios where you see, well, okay, how would diversification help me? And I found you can't explain it. You've got to show it with numbers.
Mm-hmm.
And so if you look at the number, the math behind diversification, it's really fascinating. And you'd say, oh yeah, with diversification, we got to do that. Everybody says you got to do it. Okay, yeah. And you go, no. Like, do the math. And then when you do the math, which I would say out of 100 people, maybe probably out of 1,000 people, one person does the math.
Yeah,
And if you
that
do the
sounds
math,
reasonable.
yeah, then you go and you say, all right, this is really powerful. And that's really the power behind, what we do with the Fortress Fund now.
Mm-hmm.
And we just, but I loved everything I did trading. We loved doing it. It's just, at some point you say, well, I'm going to do something. I'd like to slow down, and you try to see how to do that. And this mutual fund, that's where we've ended up with that. But let's stay on futures for a bit. We'll get to the mutual fund.
Well, yeah, I wanted to kind of ask more about the transition. You said you did really well for the first 20 years, and then
Right.
it kind of started to slow down after that. But that also sounds like about the time when you were started playing with the endowment, and like the seeds for the idea of the mutual fund started to show
Right.
or sprout, I would say.
No, that's right.
So do you think that the decline in performance with the futures trading was because like your passion was starting to shift?
No, because I mean, it was what happened is, I believe the markets, when you had the Fed start and central banks across the world, so 2008,
Mm-hmm.
Great Recession, we start lowering rates. And really what you started getting was a market where it was less, I would say, less free, in that you have really central bankers taking a much more active role in really manipulating the market the way they felt like it,
Mm-hmm.
not in a bad way. They just felt like, well, we need to have lower interest rates. Well, how are we going to do that? Well, we're going to basically print money, and you go buy, treasuries of their country, the central bankers. And so then you bid up the price of something, and, the treasuries, and then its interest rates are lower. There you go. And
Huh.
so you end up with that. Well, so many commodity futures trading, a big segment are interest rates and currencies. And currencies typically will be moved by, interest rate differentials between countries. Like now we have the strong dollar.
Mm-hmm.
Well, surprise, surprise. Here, the United States has one of the highest interest rates, and they've taken the lead on it. The 10-year, if you look at U.S. 10-years, they're, over four, about four and a quarter.
Mm-hmm.
And, where you have Japan at 0.25 still. And you have even, say, a lot of European countries in the 2 to 3.5 range. And
Mm-hmm.
so, the money goes to where they're paying the most interest. And so it would naturally mean this US dollar gets stronger. But if you
Okay.
go, so there's two markets they mess up. The Fed, the central bankers mess up when they go and they say, all right, let's put a headlock on rates and let's hold them low. And
Mm-hmm.
let's all do that together. Well, if everybody's doing it together, suddenly you've got the bond markets, the interest rate markets, which there's a lot of interest rate futures to trade. Those, don't move much. And then you get the currencies don't move much. And, a market that does not move, if it moves zero, none at all. Let's say we put crude oil, we peg it at $100, and we never let it move. You
Right.
can't make money trading it, right?
Nope.
So that's where I think that's where you saw really managed futures as an industry within, as a subset of hedge funds.
Mm-hmm.
That group didn't have as many trading opportunities. And so, over the last 10 years, now the last couple, 3 years have been great.
Right.
And, so about the time we got out, which is fine, people say, well, you wish do you ever think of starting it back up? I'm like, no, we like what we're doing now. We like the slower pace of the mutual fund. It's more like, it's like a baseball player saying, I want to retire from baseball. I want to manage a team.
Yes, exactly.
And you see that, and you see that people can really have it's another chapter in their work life, but one that they really enjoy. And that's what we're doing with this mutual fund now. But the trading, I think a lot of it still works just fine. It's just, you can't
Mm-hmm.
trade a market. You can't make money in a market that's going to be, that's really manipulated
Right.
in that way, that heavily. Markets that are manipulated are kind of scary too, because they can move in a huge way. So
Right.
okay, like let's talk the crash of 87. So I had been trading for 2 months. I'm in college, taking 21 hours at Notre Dame.
Hmm.
So I was short Eurodollar, the interest rate, the 90-day Eurodollars. They didn't have Eurodollar currency. They had Deutschmarks back then and French francs and
Oh, I remember that.
Italian lira, all that. So yeah, but they had the Eurodollar interest rate. So I was short the U.S. 30-year futures, the 10-year futures, and Eurodollars going into that. And so on October 16th, the Friday, stocks are down 5%. October 19th, the S&P is down 21, 22%, 22. So you're down 27% in 2 days. So those days were fine for me. October 20th was the day of reckoning for Salem, where the Fed, the central bankers came in. It comes in and lowers interest rates 2.5%, and in one day. So they dropped the Fed funds rate 2.5%, and they cut. So Eurodollars went up 250 points. It was a 37 standard deviation move.
Oh, wow.
Yeah, and I was on the wrong side of it. So I had a $50,000 account that had grown to $66,000 over 2 months, and then got cut in half on October 20th of 1987 to 33,000. Which at the time I recognized, I'm like, that's the biggest one-day loss percentage-wise ever in the stock market's history, more than the stock market crash of 1929 as far as a one-day move. And
Hmm.
and I was in it, and I got really run over, but I survived. And then I thought, well, this is what a great lesson when you're first starting out. And then you think back to your statistics class, and they talk about 3 standard deviations, and 99.7% of everything is within 3 standard deviations. And the lesson learned,
Is that 0.03%
that's
hiding there?
the most important thing is, the things outside of 3 standard deviations are the things that kill you and the things that make you go broke. And so you need to worry way more about that. And the sad thing for us math people is really you can't model that. You can't come up with a formula. There's almost an art to saying, okay, what could happen and how bad could it be?
Right, right. So that sounds like that was your first lesson in risk management too.
Absolutely. Yeah. No, I thought, and I had some kind of standard things I was trying to do. You want to have, different bets, and you want to equalize those bets. And how do the fancy word is risk parity that Ray Dalio uses. So that's the country folks just call it equalizing your risk across trades.
Hmm.
And so anyhow, so that's what you want to do. And that I did that, but you've got to know that extreme things will happen. And so you've got to say, look, we all, our trading career, let's say it's a 50-year career. Over 50 years, we're going to see some really big financial storms, and maybe 5, maybe once every 10 years. And one of them is going to be really, really big. And so you say, how do I trade every day so that when that big financial storm shows up, the 50-year storm shows up, I survive? And so that's where you can't, that's the saying, they say it about pilots and traders. There's old traders and bold traders, but not many old, bold traders.
Right, right, right.
So don't be too bold. You got to say, look, you got to be ready to run, and you get to be, your kind of pride and say, oh, I'm brave, I'm tough. I'm always like, no. I am the biggest chicken, and the first sign of trouble, I'm running.
Hmm.
And I'm getting out of this trade, and I'm going to be safe. So, yeah, so you learn to have no shame in being a big chicken,
Right.
because the bold people are the ones that they go broke. So,
Well, yeah, the whole idea is, I mean, you want to be able to trade tomorrow,
right.
right?
And
you can't trade tomorrow if you go broke today.
Exactly. And, and you think about, Kyle, so let's say you're right. Yeah, I see some traders that are way better traders than me, smarter than me, but they can't manage the risk. And so, let's say we have someone that's 99 times out of 100, they're right. But if they bet, as we say in the country, bet the ranch on every trade, they're going to lose it all on that one trade. That's
Yep.
so even if you're right 99 out of 100, and I tell people, I said, look, I've had trades where, or deals that I would say, man, this is a for sure deal. I would still say, even a for sure deal, your limit has got to be somewhere 20-25% of your net worth on any deal, because you see people betting their entire net worth on a deal, and you're like, never ever do that, ever,
Hmm.
because you don't know and what's going to happen. And so I just think that's dangerous. Now, a lot of people make a lot of money that way, but
It works till it doesn't, right?
right. Well, and there's another thing that's interesting too, is the diminishing kind of utility of more money. And it's a concept with betting that most people don't think through. It's like, okay, let's say you had a 90% coin, Kyle, and I said, do you want to bet on the 90%? And I would say, yeah, absolutely. And then,
Right.
and he said, you always bet on it? You say, yes, no matter what, no matter what. Why would you not? It's 90%. You say, okay, well, then let me set the scenario. Then you're betting everything you own today on it. And let's say someone's got a net worth of whatever the net worth is, whatever it is. You say, so like if you lose, if it's the 10%, there's a 10% chance you empty your pockets. I'll let you keep the shoes on your feet and the clothes on your back. And that's it.
Uh-huh.
And you say, but you could double your net worth too. You got a 90% chance of doubling your net worth. And you just say, wow, if I've got to bet everything. And so that's a helpful,
Yeah, is it worth it?
that's a
Yeah.
helpful thought kind of exercise to help people understand. You go, well, what about half of everything? Or what about a quarter of everything? And you start going, well, that's where diversification, you get back to the power of diversification. Because if you had 100 coins and there were 90% coins, and you'd said, I will bet whatever, I'll bet my entire net worth every time on all those coins.
Spread out on all those coins.
All those
Yeah.
coins. Absolutely. And I'll be laughing all the way to the bank all the time, and I will never go broke, because the scenario that, out of 100 coins, the one, they all come up the wrong way. When it's a 90% coin, you're like, it's just almost impossible, as long as the game is a fair game. So,
Right.
so risk management and diversification, as I've kind of matured in the finance world, I would say to your listeners, those are the very most important things. And once you've got those right, then you say, okay, now I need to make good bets.
Mm-hmm.
So
you mentioned the learning a lot of the education kind of on your own or outside of school. Like, what were some of the things that really helped, or that you wish maybe you found sooner in your journey? Like, are there any books or any
yeah.
people that you follow?
Well, I think things like where I got the most benefit was Jack Swagger. He wrote, Market Wizards and New Market Wizards.
Mm-hmm.
Those books, what they did, what you do now with podcasts, is you get people that, the experts in the field, and you can read the words of those experts. And
Mm-hmm.
I think hearing a voice like we're doing now is even better. And because you can hear the inflection and what they stress and what the real, you can get more out of it than just the text.
Right.
So I think like the Market Wizards books, they were good. I think, Michael Cavell, he's written a lot on trend following. There's some other trend following books out there too, but Cavell has a lot of good ones. But you can learn too from, you read about, say, someone like a Warren Buffett, or, so there's a lot of ways you can, anytime you're learning from others who've been down the road, I think that's the best. And,
I think the hardest thing with that though is knowing like who to believe.
oh, you believe the people that have made money? Yeah,
Yes,
that's easy.
but it's a lot harder to verify that these days.
Oh yeah, no. Well, and that is one thing on the future space. People say, "Well, you guys had a hedge fund, and you don't have to. You didn't." And I had one of my 8 kids had said to me the other day, "Well, I've heard hedge funds didn't have to really publish their results." And I said, "Well, that's true of most hedge funds, but if you're a managed futures hedge fund, it would mean you're a commodity trading advisor. You're regulated by the Commodity Futures Trading Commission. If you have a fund, you're audited. You do everything is regulated, much like a mutual fund. You're like, how would you
Mm-hmm.
fake a mutual fund? Or and I would say in the futures world with a futures hedge fund, unlike stock hedge funds, like say Bernie Madoff had no regulation.
Mm-hmm.
And the SEC said, no, you don't, all your investors are accredited, so you have zero regulation. On the CFTC side, you're regulated if you trade futures. So I would say those people, you could verify their results better than, if it's a stock hedge fund, then it could be, you're like, well, how is this not a Bernie Madoff, right?
Right.
Right, where it's a lie. But so that's, yeah, find the people who've made money and figure out,
And learn from them.
yeah, learn from them. That's what I would try to do, and that's what I tried to do. And there's a lot of great traders out there that, that everybody is willing to share some ideas, and because we all benefited from other people sharing ideas.
Is that why everybody likes to pay it forward?
I think
Just
so.
because it's so
Yeah.
hard to get the education that
Yeah, no, and I think you realize, in the end, we're all in the ground with nothing, and or
Mhm.
dust or ashes or whatever, and you just say, well, you like to, yeah, it's a lot of fun to make money, but in the end, we all die broke. So, and you like to
Right.
just say, well, this is fun to be able to help the next group, and when you're younger, I think you're competitive, and you go, no, this is all we're all trying to run the race, and then after a while, you just say, it's
It's lonely.
yeah, it's fun to share and help the next group, and yeah, no, I so it's and we all benefit from sharing ideas, and in the end, Zig Ziglar has a saying, there's room at the top for everybody.
Mhm.
There's plenty, it's not like a trade gets so crowded that only one person
Right.
can have it always. Usually the trade is a lonely trade. That's where my best trades have always been lonely trades. And yeah, if it's a crowded trade, it's probably not a good trade, Kyle. That's one of the
Right.
lessons you learn. You look
Oh, yeah.
around, you have a lot of company, and you're like, no, this is a sucker play at this point. I need to get out. So when the
Interesting.
party gets wild and crazy, and everybody's thinking they're smart, that's when you need to leave, because that's when.
Yes, yes, yeah. Like when your cab driver starts mentioning the Tesla.
Right,
Like,
right.
okay, maybe this is time to get out.
Yeah. Oh, that's right. That's right. Although, my grandfather, when I started, my grandfather was a very successful business guy, and he here in Texas, in Canadian Texas. And so when I told him I was going to trade futures, because he had helped with, the $50,000 to be a college student back in '88 and have 50,000 that was unusual. And that was
Yeah.
thanks to my grandfather had given me some money to help, basically to invest and to do something with it. And here I was going to trade futures. And so he said to me, he said, of all the ways to lose money, why in the heck you have to pick the fastest one? And I'm like,
Right.
oh, come on. And he said, and you see people that go broke in futures. And so futures is one that, you either learn how to manage the risk or you go broke. And
Yep.
so, it's very much like, the difference between driving on a highway or driving for, a race car. And you're like, no, if you at 250 miles an hour, if you do it wrong, you could end up dead.
Right.
But and so that's with futures. Because I know a lot of your listeners are futures traders, and you've got to be very, very careful with futures. So that's,
It's all about that risk.
yeah, it's kind of like you feel like if you do it right in futures, you're really like, it's like having a Lamborghini that you only try to drive in first gear. And people are like, what are you doing? You got a Lamborghini, you never get out of first gear, Kyle. And you're like, well, I'm not dead either.
Yeah, yeah. That's a great point.
So you use it just enough, but there's a lot of the great thing about futures is the diversification you can get. I mean, imagine the different bets you can make that are not correlated. I mean, if you're
Mm.
betting on, coffee, and you're betting on crude oil, and or the Japanese yen versus US dollar, you've got three different bets on, and you go, those have nothing to do with each other. Whereas you could be trading, let's say, Tesla and Apple and Netflix, and you're like, well, odds are every day
Right.
they're going to move the same.
Mhm.
So different names doesn't mean behavior different from a mathematical perspective. But if you look at futures, you can get much broader diversification, which is awesome.
Mhm. Let's kind of pivot now and talk more about like what you're doing with the fund FORTX.
Yeah, FORTX is a symbol. Yeah, Fortress Fund, the Abraham Fortress Fund is the mutual fund. What it does, what we've tried to do, again, kind of to the baseball analogy of trying to hire your own baseball traders. We do,
Mhm.
so we did used to do stock index arbitrage, right? So we understand how to index, and so what we do is we pretty much index our stock exposure. So we have stocks, we have fixed income, and we have alternatives. And the diversifying strategies is the way it's defined in the prospectus, which is hedge funds. We have currently, our diversifying strategies are We have 7 different hedge funds we invest with, third-party hedge funds,
Okay.
not our own. We don't have a hedge fund anymore. We have just this mutual fund. That's the only thing we do. So we invest with these 7 third-party hedge funds, and then we invest. We do a little bit of trading every once in a while ourselves. Like we typically always have some long exposure to gold.
Hmm.
We usually 10% notional long exposure to gold with futures. We do that because and so there's this diversifying component that we put somewhere between we're 10 to 30% of our cash in it. We tend to have there's a little bit of leverage in there, so it ends up being about 35% exposure is where it would be today, and then we have stocks at 50%, 50%, and then
Hmm.
fixed income's at 15. So, and our fixed income is U.S. Treasuries. So, what we're trying to build here, Kyle, is, and the idea, the name of Fortress Fund is a fortress from the financial storms. You say, how do you build something that can fare and weather the storm better than given the tools you have?
Hmm.
And that's our answer to that question is, well, given our understanding of alternatives, if you go to the right hedge funds, you can plug those hedge funds in and make it work and have a better portfolio. So we're trying to do that, is use our understanding of the hedge fund space to build a more storm-proof portfolio than most people do have.
I'm looking at the stock exposure, just kind of seeing where like your investments are broken up, and I noticed that there's at least as of December 21st of last year, there was about 24% in tech. I was curious if you're still that heavily invested in tech, or if you guys have reduced that.
Well, it's what we've done is it's still similar to what it was then because mostly we've indexed it. We
Okay.
so what we do is we're not stock pickers. We're very much top down. We just want the exposure to the stock market, and we just do a no cost stock. Again, if you do index arbitrage, you know how to build an index, which we do. So we just build our own index. And so if you look at the percentages there, it's like an index,
Hmm.
except for one sector. So if we do anything, we tend to do it in a sector, and the sector that's heavy right now and has been heavy is utilities.
Yes, I
So
see that too.
yeah, so utilities we've overweighted utilities. We did that back about a year ago. And so what we did about a year ago was before Thanksgiving, we had of last year, we had 20% exposure to US Treasuries at a duration of 8 years. We
Hmm.
cut that to 15% and we of exposure and 6-year duration. So we did that because the Fed was clearly uh, showing and telling everyone, hey, rates are going to start rising.
Hmm.
And then the other thing we did, we had about 50% exposure to stocks, but we had stock exposure with the stocks themselves, but also stock index futures. So sometimes we'll use EFA futures and S&P futures to get exposure to stocks that way. So about 60% of our exposure is actual stock names, and
Hmm.
about 40% of our stock exposure is is notionally through futures trades. So if someone looks at what we were holding, you'd see, some like EFA futures was how we get our non-US stock exposure. So
Hmm.
yeah, so we've got that, and then the fix. But the idea, see, is most people have like 70-80% stocks, and that's not right. I mean, that's not diversified.
Right.
I mean, you may have a diversified portfolio of stocks. That's fine. But if, let's say you have the Great Depression and you've got stocks going down, in the Great Depression, stocks were down right around 80%. And that's if you include dividends. If you don't include dividends, it's like someone would say 89%. But
Oh. Oh.
I see 79% including dividends. So if you include, which is the right way to do it. So if that happens and you're, 80% exposed to stocks, 80 times 80, you're 64, percent loss there, and you don't have fixed income helping you. So I think 80% exposure is too much. That's what most endowments have. And I just say, I think that's too much. So in the Fortress Fund, we have 50%. Our range is 40 to 60. We tend to be 40 to 50 is where we
Hmm.
tend to range. And, again, we're top down. So sometimes we'll lower it, like going in January of last year, we lowered it to 40% exposure. And when Russia was surrounding Ukraine, for instance,
Yeah.
we lowered our stock exposure to 40, but we also put on 5% long crude oil because we felt
Hmm.
like that would be a hedge on our stocks. We said, well, if Russia invades Ukraine, we think stocks are off somewhere 3 to 5%, but we think oil is up. And we liked the oil trade anyway. We said, well, if we were still trading our hedge fund, we would be long oil anyway. It was
Hmm.
a good uptrend market. And we said, all right, let's put on 5% notionally funded. It's a notional 5%. So of Brent crude oil, and that helped hedge our stocks some there. So things like that we'll do occasionally that, having traded in 90 different futures markets around the globe 24 hours a day, you don't mind
You pick
working.
up some things.
Yeah, you pick up some things. Yeah. Well, you say, well, you could go. One of the trades is you could get long wheat, on Ukraine. But we said, well, we didn't want to we do that. But I mean, there are times that you could do, you can put on trades in markets that protect you because stocks, the best way, the most straightforward way to protect yourself in stocks is to buy puts. But that's a dumb way. I mean, it's
Hmm.
usually way too much, too pricey. So you
Right.
shouldn't, that's like, look, come up with a creative way that if the event happens that's going to knock stocks down, what else is going to happen that you could make money off? So
That's an excellent way of thinking about it. So that brings me then to utilities, because you mentioned that pre-market too. The energy markets is something that you are, I would say, currently bullish on.
yes, yeah, no, utilities. Well, we like utility stocks because we think they can adjust for inflation. They can weather an inflation storm better, and
Hmm.
because they can raise prices. But then also just the energy space, and we haven't expressed this as much. We see some of our hedge fund traders doing that, and so what we've seen this year with the hedge funds, what they've done this year with us, they've made up for losses in stocks and fixed income. Our hedge funds, of the 7 we've got, they're between flat and up 28%. But
Hmm.
on average, if we have 35% exposure, on average, they're up 20%. So we're making 700 basis points in that component that was designed to be diversifying. Not really a hedge. People say, well, when they're going to make money when stocks go down. You go, no, we hope they make money all the time. This is a big year. They make money when markets are volatile, typically.
Right.
So,
Right. Right.
so if you make 700 basis points there, and the stocks and the stocks and the bonds are losing, about 11%, then you go 11 to 12%. So that puts us down about the 5 that we're down this year. So anyhow, so the risk is, and there's risk to that. So it doesn't always work that way, but that's how it's worked this year, and that's how we try to do it. But so what we like about the hedge fund traders we had, they made good money in energy this year doing trading in
Hmm.
the energy markets. But we also personally we see, we're bullish, any energy, green energy, oil and gas, whether it's carbon or green energy is it's it's hard to do energy, Kyle.
Yeah.
And so oil and gas to drill wells, the cost of drilling wells has gone up about 70%. The cost of building windmills, and wind turbines and solar cells, all that
Hmm.
takes material, and that material has gone up in price. Steel pipe has gone up about just a little more than double since a year ago.
Yep.
So in the last 12 months, if steel pipe goes up, you're like, okay, you need that for all kinds of energy, really any kind of construction.
Hmm.
And so those things are going to, I've said, like in oil, $100 oil is the new 50, and 200 is going to be the new 200, or 200 is going to be the new 100, because normally here we're at 90, $95 oil. Normally you'd have people drilling like crazy, but
Yeah.
we have less rigs now in the US and worldwide than we had in December of 2019. Active rigs. So active drilling, saying we're going to go drill a new well because, man, we're going to make all this money. Well, so December 19th, before COVID, we had $60 oil then. We had $2 natural gas.
Hmm.
Today, we have $7 natural gas, 3.5 times. And we've got, 90, we've got a 50% on oil. So if you raise the price of something 50% and 300%, you'd say, well, they're going to get busy and get to work. And you go, no, they're actually about 7% less rigs active now than before. And you're like, well, what? That doesn't make any sense.
Yeah. No.
And then
Doesn't.
you get President Biden saying these oil companies, they've got to go do this. He's mad and he's releasing oil from the strategic reserve. And I'm like, whatever politics you believe, you say that's not a good idea. This strategic reserve was not designed for politics and winning friends. It's designed as a safety net for the U.S.
Right.
So he's going to run out of oil. He's making OPEC mad. He's making oil and gas companies mad because he's saying all this stuff. And you got to look at this situation. It's like if you were to build a house today, and most people can relate to that more and say, wow, it's going to cost so much to build this new house. I'm just going to go buy an existing house. Well, the costs are up. It's more expensive. It's, so you'd say, look, it's not as profitable right now because of the cost going up. And so, if everyone looks at these prices and they're thinking pre-inflation prices, and you go, look, inflation works with everything. And the cost of drilling these wells, the cost of making the oil is just like when you go to the store or you go to a restaurant and you look at the food prices, and you're like, why are these food prices through the roof? And so to me, oil, I think 150 minimum, I see 12 to 24 months out, $150 minimum. And I think it hits $200 a barrel.
Wow.
At some point, 12 to 24 months out. And people are going to be mad and thinking everybody's, these oil companies or whoever. And I think, but it's like, well, why don't we go the green people? Go price a turbine.
Yeah. Yeah.
You have a solar cell. Let's do that. And you're like, well, that's up. And, buy a new car, buy a new tractor, buy,
Everything's going to be up.
Go buy a 30-foot joint of pipe. And you're like, it's all up. And so anyhow, now that's interesting too, though, Kyle. Back to stocks.
Well, before we do that, I do remember seeing at one point energy or oil producers in the U.S. saying that they weren't going to restart production even if prices got I think they said like 95 or 100. And is that the reasoning then? Is that
no? Well, so the restarting they'll produce. So think of a well as like having a rent house.
Mm-hmm.
You build a rent house and then you rent it out, right? But what they're not going to do is drill new wells.
Right. Yes.
So like the rent house guys say, well, I can't afford to build a new rent house because rent houses have, to build a rent house is up, 70%. I can't, I'm just going to rent the ones I've got and raise the rent on the ones I've got, but I'm not going to build new houses. And so that's what they're not doing is drilling a new well to make more supply. I've got these wells that are, we make this, 11, 12 million barrels a day in the United States. Those are producing fine, but I'm not going to go drill any new ones because the cost is so high. So that's the problem.
So then to tie that back to stocks before I so rudely interrupted you.
No. So stock. Well, see, that's stock. So inflation affects everything.
Mm-hmm.
So yeah, I think what people forget, Kyle, is that inflation is they'd like to compartmentalize it and put it in and just say these things are going to be inflated, but everything inflates across the board, including earnings of companies. So this is something people haven't talked about much that I think is going to be interesting for stocks.
Mm-hmm.
So if you look at Argentina and you look at inflation in Argentina since 2010 to now, and judge inflation by the devaluation of their money, which is what inflation really is, their money being worth less. So if you look at it, okay, how many pesos does it take to buy a US dollar? So the dollars are the benchmark of inflation to them devaluing their currency. Well, their currency annually gets devalued 40 to 50% a year.
Oof.
It was 4 Argentinian pesos back in 2010 to buy a dollar. It's now like 300. So that's a long slide of inflation that's there. But their stock market has gone up 40 to 50% a year. So that's what's fascinating is people, they want to just say, well, this is, just my, the hamburger meat, that's all it's going up, or gasoline's going up. You go, no, everything will be higher, including earnings of companies. So when you do a discount model on stocks, you say, well, we're higher interest rates means lower bond prices, lower stock prices. Yes, but if we inflate earnings on stocks, not on bonds, but on stocks, we can if Apple, if the revenue of Apple goes up 20%, the expenses go up 20%, still their profits 20% higher. So once we get to that point where people kind of get their footing at this new inflated, all these higher numbers, you'll see you'll see this earnings increase with companies having higher earnings. And I think that's where I think the bottom is in for the stock market too.
Okay.
So I think that part's not baked in. I think all the negative news is baked in. And I think at some point here in the next, 6 to 12 months, China is going to be back. They're going to do away with COVID zero, maybe even in the next month or two, sounds like possibly. And so you get rid of COVID zero in China. You get COVID completely, in the rearview mirror. Everyone all over the globe is going there. There's no supply chain issues, but prices are going to be higher across the board. If you had 25% to prices of everything, and wages, everything goes up. Sudden you look around, you go, oh, earnings are higher. So really we didn't lose any ground on stocks, but the higher interest rates, that hurt us. But you may have too, I think that's been priced in. So that higher interest rate priced in. What's not priced in is the higher earnings, I don't think. And so I think the lows may be in. And so that's what we're thinking. We went back on our mutual fund to 50%. We've been 50% stocks, which is really our peak for the last 6 weeks, or well, more than that, 2 months. Yeah, 2 months.
Well, I think we're recording this before CPI comes out for October's readings.
Right.
I think really that's the big number everyone's waiting to see, right?
Right. But I think, though, and I think the Fed needs to remember, we all need to remember, you can start putting the brakes on, but the brakes are on, and they're going to take a while to take effect. You're trying to slow down a train.
Yeah.
And so
Yep.
it's, this number won't be probably the number that the Fed's looking for. I know they're looking for, well, let's have it go in the right direction. And so, yeah, no, it'll be an interesting number. But I just think that the real challenge as a trader is you want to be ahead of the crowd. And so you want to say what's gotten baked in and where will the crowd go next? That's the real challenge. Is what I think people don't do is I say, what happens next to the fourth power? And I'm like, what happens next? Then what's next? Then what's next? And what's next? You get out 4 iterations of what's next. You put that puzzle together, you can make a lot of money. If you're just thinking what's next, everybody's thinking what's next. So the way to get ahead of the crowd is you need to get several iterations out. And what I think happens next is I think the Fed has made their point. They've raised interest rates, but this isn't like we've never had. These are still low rates historically.
Right.
Yeah.
Right.
So we're fine. The economy can be fine at this. And what happens next too is, well, China does away with COVID zero. China gets back to work 100%. They start consuming more, and then, some of these supply chain issues work themselves out. At some point, Russia, Ukraine works itself out. And then you start saying, okay, we're going to get back more of the status quo, regular ho-hum economy. And I think things look pretty good there.
What about with the Fed still actively trying to reduce their balance sheet? Do you think the pulling of that liquidity still represents
that is a bigger deal, I think, than raising rates? I think at some point they're going to have trouble.
Right.
There's a debt problem worldwide that I think is going to come back to roost at some point. And I think there's more of a currency issue with that. With worldwide, is our currencies, do they really mean anything if we're going to print them, the way we do? Just
Well, it also seems like there's a lot of foreign governments that are trying to get away from the dollar standard too.
Right.
Like I think we've actually started seeing some people starting to shift towards yen or yuan or however you say the Chinese currency.
Oh, the yuan. Yeah.
Yeah.
No, I agree. Yeah. No, I think the dollar, is still the reserve currency of the world, but it's going to be continued to be challenged. And I think given the money printing that the U.S. did during COVID, that calls it into question. We printed 40% more money. You make 40% more of anything, and the price is going to go down.
Right. You would think, right? That's just supply and demand.
This idea, this inflation's transitory. It's like, what about printing 40% more money? Yeah, no, inflation was definitely caused by the money printing. Yeah. And there was some of it's transitory, this supply chain stuff, but the biggest part was that. And normally you see the currency being about 50 to 60% of the money supply being 50 to 60% of the GDP. And that's been true back to the 50s,
Hmm.
even before, we went off the gold standard. So you say, it's kind of like a poker game. How many chips do you need? It's like, well, how big's a poker game? And you go, okay, well, you need enough chips to
Right.
have, and you kind of figure out how many chips at the poker table, given the size of the game. That's the way it is with money. And 50 to 60% ought to be the number. And worldwide, or in the US, we went up to 90%. And so you say, what's going to happen? Well, then everybody starts, paying too much for things. They bet bigger. At the poker
Mhm.
table, you give everybody extra chips, they bet bigger.
Right.
So that's it. So, yeah.
Salem, this has been one heck of a conversation. I think you've given us some awesome things to think about going to the future, especially like paying attention more to like I definitely want to check out that Argentina inflation versus the stock market performances, because that's something that I've heard people talk about before, where inflationary environments are usually good for the stock market, but I don't think I've ever actually watched it or looked at it like visually and seen it like
Yeah.
spelled out for me like that. So
It's, because Argentina basically they just have inflation all the time, but they don't go completely off the rails. And, Ecuador. So here's, if you're going to do Argentina, if you take it a step further, you become like Ecuador. I was in Ecuador and I saw their Central Bank of Ecuador is now a museum, and they use US dollars. So if you go too crazy,
right.
that's where you end up. Your Fed is going to be, your central bank is now a museum, and it's a beautiful building and a beautiful museum. But it's funny to me to be a museum and they use U.S. money there. So that's where I worry the U.S. And that worldwide, if we all keep printing money, which I think we're going to stop, but it's gotten to be. Yeah, you need to look at Ecuador too. Go look at the Central Bank of Ecuador, and you'll see a beautiful museum. And that's a quicker exercise,
I love that.
Faster, easier exercise, but it's one that's instructive as well. So yeah, what happens when you really print a lot of money? So hey, well, Kyle, it's great to be with you, and I wish that your listeners all the best, and we I'm rooting for you and everybody out there trading, and yeah, we can all make money together and be smart together, and everybody, there's different ways to do it, and so yeah, so it's fun to be with you. Thanks for letting me hang out with you.
No, thanks for joining us. It's the successful guys like you that come on and share the knowledge and things that they've learned over their trading experience that really helps push us forward. So we really do appreciate you giving us the time. One last time for the listeners, where can they find you if they want to check out and learn more about Abraham Fortress?
Yeah, if your listeners want to learn more about Abraham Fortress Fund, our website's the best way to go, and it's at abrahamtrading.com, and there's lots of material there, and the performance and everything, they can find it there, Kyle.
And then we'll also have your LinkedIn in case any people want to check you out.
You bet. Yeah, LinkedIn. I'm active on it, and so yeah, go check that out too.
All right. Well, thanks again for joining us, Salem. And thanks again, listeners, for sticking around to the end. Fortunately, people like Salem have jobs and commitments, and they can't sit and chat with us all day long, as much as we'd like that. But don't be afraid, because we'll be back at you guys soon with another amazing episode. So until then, take care.
Two Bulls in a China Shop is an entertainment program, and all thoughts and opinions expressed in the show belong to the hosts and not of any company. They are not intended to provide specific advice or recommendations for any individual or on any specific security or investment product. It is only intended to provide entertainment about stocks and the financial industry of trading. If you make trades based on what you hear in this show, you assume all risks for those trades.
You're not just some reckless rookie, YOLOing your portfolio, ready to risk it all on some shiny new coin. You're on Robinhood now, trading ETFs, tracking the S&P, working that DCA. You're breaking free from bots, bankers, and all that bull. You're doing it all, and on your terms. Because no one runs your money like you. Stocks and ETFs offered by Robinhood Financial LLC. Member SIPC. Crypto offered by Robinhood Crypto LLC. All investing involves risk.
Black Friday deals. The gifts are unreal.
Shop JCPenney for thousands of deals so low, no coupons needed. This weekend, save up to 50% on kitchen electrics from brands like Keurig and Cuisinart. Say yes, please, to diamonds and gemstones, now $19.99 each. And bundle up the fam in coats, starting at $14.99. We got your holiday.
Black Friday deals. Shop, JCPenney.
Offers valid on select items 11/18 through 11/20. Excluded from coupons. Exclusions apply. See store or jcp.com for details.